All right, hey there everyone. This is the final video lesson in the conversation we're just having about trading with the Greeks and what the option Greeks are and differentiating between the different Greeks and what they mean, as well as just kind of how you can use those to manage existing trades, to construct new trades. And while I've talked pretty extensively about the different ones, just understand there is a lot more to them. And while I think we've given you a very good introduction to them, delta and gamma, I think, are probably going to be the number one, specifically dealing with price. Because if we say we're non-directional traders, which is what I am, if we say that we have no opinion about price, which is what I say, and if we want to generate monthly premium, either for income purposes or for growth purposes, the way to do that with a non-directional opinion is by keeping a positive theta, all right? So all of those factors, while maintaining what your volatility level is doing in the market, really help you create the best set of circumstances to make profits week in, week out, month in, month out, quarter in, quarter out, year in, year out. All right. And so while I think that these Greeks you really have to get a handle on, the bottom line is what's going to make you profitable is how you manage your overall trade positions, right? So this quick reference here, I'll bring this over here, something I just kind of threw together just about various different Greek adjustments that you might need. I will post this as a external link so you can either download a copy of it, or if you can just, grab screenshots and make notes, write your own if you want. So essentially, this is what I've done here. I've made a quick reference, and if you need to do the following, then these are some of the choices to consider, all right? So if my position is getting way too short delta and it's getting way too short vega, and so to offset that, I want to add some more delta to it, I want to add some more vega to it, well, these are some of the choices that I can do. So what I think I'll do is I'll walk through, I think this lesson right here, again, I am going to show option view just because it's the only way I have the ability to step through in time. If I show you a chart here, I can step through in time and I can pick any set of dates, dating all the way back to, I don't know, 2001 or maybe 2002, and I can step through a trade day by day and see how it would be managed. All right, so I can look at anywhere along here. What I think I'm going to do is I'm going to go ahead and come right around this area here. All right, I think I want to come right around this area here because we had a nice little drop in the market followed by a pretty good move up. We had a really good increase in volatility, and I want to show you how that affects the Greeks all together working as one unit, okay? So I think what will be the best thing to do is just to start right here, this area, about the beginning of February, and show you how a trade handles coming out of high volatility back down into lower volatility. So let's do this. Let's go into BackTrader, February 3rd. And we'll just go right to the end of the day here and use some of these examples, illustrations, just to show you how all these Greeks relate to one another. All right, so I'll come into the Russell. You'll see that we had a pretty substantial down day on this day, 36 points down. This category has options that expire in 46 days. So you'll see on February 3rd, if I come into the market right here, maximize sell, what is this, February 3rd is right here. Big down day right here. All right, so let's say that this just happens to be the day that I want to put on a trade. It's a Wednesday, now it's a Tuesday, Wednesday, Thursday, Friday's the 6th, and you've Oh, it was a Monday. Oh, well, there you have it. So it's on a Monday, big down day. We'll put a trade on, and then you'll see that it promptly reverses right off the low here and then drives up, you know, boy, well over 100 points in under a month. It got all the way down to here to 1080, got all the way up here to 1213. So this will be a great example to just show you some of the things I've been talking about. So if I come in here, I have no opinion about the market, but now I see that the volatility has increased. It's increased. You'll see this is on a daily basis. This goes back in time. You'll see 2008, high spike. 2011, again, big spike. But you'll see that it is now, on this date, February 3rd, 2014, it's getting up to the upper edge of where it was for the prior year. So this tells me this is a pretty good time to take advantage of a down day, a nice little increase in volatility, and let's go ahead and put on a trade. One of my favorite trades of all time is the following, and I'm going to show you and we'll walk through it. And it's basically you take and you do a put credit spread, you go out of the money. So let's say right here I'm going to go, I don't know, we'll say maybe go 10 here. All right, so it starts out as a put credit spread. This is what it looks like. And then I come right up here close to at the money, and let's just say I want to do maybe 1 or even 2. All right, so it gives you this kind of a profile, if you will. I've got zero risk to the upside. I've still got a pretty healthy amount of profit potential to the downside, you know, by 100 points or so. And the maximum margin this trade will set me back is about $15,000. So right off the bat, you'll see that there are parameters or there are assumptions that I know right away, right off the bat. And what I want you to pay attention to is my delta is a little bit positive. My gamma is going to be negative. Theta is positive. Now my vega is also negative. And the reason why I've constructed it and set it up in this manner is because, remember, I want to take advantage of this right here. Right here we are on February 3rd. In this range right here on this date, we've had a nice big move up in volatility. So I want to be vega negative so that I can take advantage of this drop. And what you'll notice, I could fast forward right here to February 7th at the close of the day before the weekend, and we'll see that the volatility, I mean, it dropped substantially. And with all things being considered, I make no adjustments. Watch how much profit comes into this trade. So if I convert the trades, you will notice right off the bat, my gain and loss is minus $24 purely based upon commissions. Okay, this is the profile. I know for a fact I'm going to make at least $576 on a $15,000 trade. So right off the bat, I'm up, 4%. Those are my assumptions. Minimum I'll make is 4% on this trade. My maximum I'm willing to lose is 10%. I'm willing to give up $1,500 in order to make $500. All right. So we'll just say that right off the bat, that's if I've got a $15,000 trade and I want to risk $1,500. Well, I do that over and over and over again. I have a strike rate, we'll say in excess of 85-90%. The risk to reward doesn't bother me one bit because over time you'll learn that $1,500 loss is all but I dare say impossible, but it's pretty difficult. You have to really be asleep at the wheel to have that happen. So anyway, let's just move forward here. You'll see that this is the end of the day. I move forward, we'll just say 2 days in time. So this video doesn't become super long. And you'll see right off the bat, now this trade is up $236. And you had another down day. We will zoom in here, we'll turn off the volatility, and we'll make these candles. So this was the day that it was put on, right here. Okay. This was the day that it was put on. You had the next day right after was kind of an inside bar day. And the very next day, you had a further move down. Why in the world did we make $236 in 2 days' time? Well, I hope that you understand it's because of your volatility impact, right? What happened here in volatility? We put it on the 3rd. Volatility at the close was 27.19. At the close here on the next day was 25.8. So we had a 2-point decrease in volatility. Therefore, remember, our Vega was the negative number, so we had about a $200 profit into this trade. Step forward another couple days to Friday, the end of the close. And now you'll notice that we had to move up, and what's our profit? We're up $700 in 4 days. I mean, I hope that excites somebody out there. I really do, because now what I want you to notice is Delta has maintained a very neutral stance, meaning it's around zero. It's close to being Delta neutral. Our Gamma is still relatively, small. Our Theta is still positive. Now our Vega is still negative, but what you'll notice is, as I said in that lesson about Vega, is you start moving farther away from where your shorts are, okay? These are the options that we sold at 1070. 1070 are the options that we sold right here. These we sold, we bought those as protection. These we sold at 980, and we bought further down of that for protection, all right here at 960. So as the market begins to move farther and farther and farther away, here's the market, here are the shorts. Well, they become less sensitive. Here's the shorts, here's the shorts. They become less sensitive to changes in this volatility. So at this point, you can make a couple of choices. You can close the trade. You can say, I've made a great return in 4 days' time. I'm going to wait for the next trade to come about. Or I'm going to manage this trade and really try and step on the gas pedal and make some more profits. You can reduce risk. You can bring this whole structure forward. You can, further adjust to take advantage of volatility. But the whole point is you want to maintain control of these Greeks throughout the life of the trade. Now, let's just fast forward, let's say a week in time. Let's say just, the assumption is we've done nothing. We'll fast forward quite a bit in time and we'll just see what the Greeks have done. Well, now you'll see that our Theta is still positive, but it's essentially next to nothing. Our Vega is still negative, but it's essentially next to nothing. And our Delta, again, same thing. It's still negative, but is essentially next to nothing. And why is that? Because look at how far away we are. Let's go ahead and make this interval a little bit smaller. Look how far away we are from where our options that we have bought and sold are. We're way, 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 way far away. As you get farther away, if you can pay attention, if you can look at all of these down here, you've got Delta, you've got Gamma, you have Theta, you have Vega, all right? So as you get farther and farther away, look what happens to your Theta. It begins to get smaller and smaller and smaller because you're farther away from where the bulk of your position is at. Same thing with Vega. As you get farther and farther away, it becomes less sensitive to changes in the volatility. And your Delta, max, as I said, is right around where the market is trading at. So you've put yourself in a profitable position while at the same time still keeping control of your Greeks. Let's just say there's still 28 days to expiration. Remember what I said in the last video lesson about, some strategies begin at 30 days to expiration, and what they do is they attempt to use this acceleration of this curve right here, right? So let's just say that now we've got a trade that is, we want to start at about 30 days, and we want to take advantage of the rapid expiration or this time decay. We want to take advantage of that decreasing faster than, when we went farther out in time, and we'll put on a new trade. Now, What has happened to volatility on February 21st? Well, February 21st, you got volatility way down here, lower edge of the range. We have no idea if it's going to keep dropping or if it's going to go up. So what do you think would be the best way to put a trade on? And you'll see it just kind of chops around there. It doesn't really do much of anything. It doesn't drop lower, doesn't drop higher, not for about another month until it kind of spikes back up. If I wanted to put a trade on that kept my delta pretty neutral, added some theta, didn't really do anything to the Vega, well then maybe I'd look at this and I'd say, okay, what do I want to do here? I know if I get long theta, if I am positive theta, I could come right at the market and I could do something like this. I could say, all right, I want to sell 5, I want to buy 5. It's a simple calendar spread. And what has that done? Is that has taken my delta from -2 to -6. It has taken my theta from +5 to 58. So again, these are the theoretical numbers of how much profit I will make in each day passage. And then it takes my Vega from -6 to +259. Again, for every 1 point increase in volatility, I will make $259. For each 1 day that passes in time, I will make $58. And I've got pretty limited risk to my delta. So what does that do? Is that creates a trade that looks very ridiculous, right? I mean, that looks absolutely insane. Who wants to trade something like that? But you're keeping control of your Greeks. So that is the whole point. If you manage this, if you keep your Greeks in check and in line, well then you become less concerned with what this profile looks like. And while yes, you've added more margin to this trade, what you've also done is you've added a lot more profit potential. So let's just convert that. Let's just see what happens. I have no idea. I'm doing this on the fly. So, I'll learn with you and see what ends up happening, because we've got here on the 21st of February, I want to say, all right, I have no opinion, but what if I also wanted to reduce this Vega? I don't like Vega being this positive, but I don't want to make too many changes to my delta. Well, I can add some short Vega by doing a call credit spread, or doing an at the money put butterfly, or doing an out of the money put broke wing butterfly. So you have choices, you have options. If I wanted to do something, we'll just say like this, I want 5 here and 5 here. Well, that's too much. It definitely gave me a boost in theta. It definitely helped neutralize my Vega, but it changed my delta way too much. I'm not willing to accept that much of a change. Same with here. Maybe I don't like that so much. It changes the delta, changes the Vega, changes the theta, and you'll see that that's what ends up, what you end up wanting to monitor. So we'll just go for it a few more days and see what ends up happening. Again, you have no idea. Let me just back up here because I'm stepping through an example, kind of in real time here. You have no idea what the market is going to do. So at some point, remember, you have to close a trade. You absolutely have to decide at what point am I going to be happy with profits. Was it $300? Was it $500? Was it $10,000? If you don't start that trade plan out, and I urge you to go back to the boot camp and to the option foundation lessons, the 3 key components are maximum profit, or potential profit. What do you want to make? What are you willing to risk to make that happen? And where are your adjustment points? So at the very beginning, I knew this was a $15,000 trade. I said I'm willing to lose $1,500 to make $500. All right. The reason why I didn't identify specific adjustment points is because I'm walking through this example to show you how trading by the Greeks is a very, very insightful way to trade your options. And if you don't even know what Greeks are, well then how are you going to know what to end up trading? All right, so now at this point, let's just march forward. We have delta that is becoming negative, meaning price moving down helps us, price moving up hurts us. And you'll see that right here on this dotted red line. Price moving up hurts us. We go from being profitable by about 4%. If it moves up to here, we're going to give away all of our profits. If it keeps moving up, we're going to be losing money. So right off the bat, you'll notice that a negative delta hurts us to the upside. I'm still positive theta, but my vega is now getting bigger because I'm staying right around the market. So if I want to correct that, if I want to decrease my delta, maybe decrease my vega, what does this tell me? Short delta, short vega. Well, now it's time to maybe come in and do a call credit spread or an at the money put butterfly. So what if I came up here and I went, all right, now I'm going to do a call credit spread. I'll do the same thing I was going to do before. And what am I going to get here? You know what? Here's what I did. All right. If I am short delta and short vega. So, you know what this is? I need to maybe term this a little bit better. All right. This is my position right now. I'm short delta and I'm long vega right here. Short delta, long vega. So my adjustment is going to be an out of the money put calendar, an out of the money call diagonal, a put debit spread, not a call credit spread. That didn't sound right when I was saying it, so I need to reword that. If I went out of the money put debit spread, well, let's just say I came way out of the money here and I went buying to, selling to. Look at what that does, right? It makes my delta even more negative, and it makes my vega even more positive. So then I'm going to just go out of the money. I'm going to do a put credit spread. Now it starts correcting things. So the experimentation you need to do will help reinforce some of these lessons. Well, now, boy, look at what that did. Flattened our delta, gave our theta a boost, and decreased our vega somewhat. Now, see what that ends up doing for us. Now that flattens this dotted line out some while maintaining us in a profitable position. We'll go forward a couple more days and we'll just say, at some point now I'm getting closer to these options expiring. When am I going to be content and close this trade? We've just absorbed a 32-point move up on March 4th. So what that looks like here is March 4th, right here. All right, let's just say that this hasn't happened yet. March 4th is right here. So you have March 3rd, March 4th comes, you have a gap down, and this is our volatility. So volatility dropped incredible. March 4th here on the actual chart. Let's just zoom in a little bit here. So right here, you've got a gap open, and look at this 32-point move up, which caused this to drop and come down. So the move up in the price caused the volatility to move down, and yet we are still in a profitable trade. But look at what's happening. Our delta is getting way too negative again. Our theta is still positive. Our vega is still positive. At some point, I've got to decide, when am I going to be happy with this? Not to mention, look at how much margin I'm adding to this trade. So all of these elements come into play when you start talking about using Greeks to manage positions. But you'll see by looking at this, my maximum margin is truly only about $27,000. All right? My maximum I could lose is $27,000, but I absolutely need to start doing something to neutralize this trade. And a very simple adjustment is, remember, these were way, way, way down here. What if I just took and did the reverse? Well, it helps a little bit. It gets rid of some risk. it really cleans up the margin requirements, and so doesn't really do anything to this profile. But what it has done is look at how much margin it has removed. Now we've only got about $7,000 in margin to keep this trade open. But we need to do something to correct this delta. I need to get some positive delta in this trade. Well, what if I just close these up? Would that help? Not so much. But you know what it does do is it adds more margin to it, but it helps control some of this vega. So we'll just convert that. And then lastly, you can start unwinding some of this position. We're getting closer and closer to expiration, so maybe I'm just going to go something like this. Or maybe I will go something like this. You see, there's all these choices that you can make to get this corrected into something like that. And again, you have to practice, you have to experiment, and the more experimentation you do, the more proficient you will become at some of these adjustments. So we'll just go forward. We'll just say to the end of the week, we'll have about 14 days left, and we'll see what happens to our profit. Oh boy, look at it. We're still right around there. Delta, we're just having to chase this the whole way up. Why? Because remember, what did I say? We started this back here. We're going to have to absorb like a 100-point move up, and we still made money. So, you know, we could go all the way up until the Friday before these options expire. Again, when they expire, you cannot do anything with them. You cannot trade them once they expire, and they're a week away from expiration. And you'll see now this is our position that we're in. When do you think this is going to offer you the maximum amount of decay? Right here, right at the end. These final 30 days, when this curve slopes off and that time decay is the most it will ever become, you can see how a trade that is up right now, about $1,900, still has the potential in 7 days to go from making $1,900 to making almost $10,000, or making $6,000, or coming all the way over here, making $0. So you've got a range from $1,235 to $1,135. You've got a 100-point range in the market in which to stay profitable. All right, so again, don't get greedy and try and, you know, hit home runs every single month, but maybe you're content with this. And maybe you'll say, well, it's a Friday. I will wait until Monday, and I will close it up on Monday, no matter what. Period, end of story, and I'll take what I can get. Well, look at what you just made, $3,300. And the market moved up 6 points, and you endured a weekend. So, I mean, there will be, I intend and I plan on showing you just many lessons like this, just to show you different methods, different strategies, talk about all the different trade potentials. But for this lesson, just kind of closing up this Greek conversation that we're having, it's all about just understanding what kind of an adjustment you need to make. All right. So if you're short delta, long vega, you know, you'll consider one thing. If you're long delta, long vega, you'll consider something else. I'm going to go through and make sure that I make this a little bit easier to read, so please just disregard this right now. Let me just do this right here. Put a big O X through it. Don't look at this yet. I will update it, and I will make sure that it's a little bit easier to read, because you need something like this, a quick reference, so that you can say, this is my position. What do I need to do? It's a daily fire drill that I need to run through, a quick set of circumstances. If the market goes up, what am I going to do? If the market goes down, what am I going to do? If the market stays here, what am I going to do? And these Greeks, understanding what these Greeks are all about, delta, gamma are price, theta is time, vega is volatility. By understanding what these all represent, I think that puts the edge in your favor significantly, so you know when it's time to make an adjustment, what you need to do. Okay, but again, start simple spreads, practice, go through the boot camp lessons. You should be well practiced for 12 months before you even consider doing some of this. This is high level advanced jujitsu. When I start talking about, using only Greeks to trade positions, that is not how new or intermediate traders should even be trading. You trade simple methods, simple strategies, take your profits, absorb your loss, and at the end of the year, more wins than losses, and you'll be successful in this business. All right, so anyway, I'm not going to keep rambling. I got more lessons I want to put together for you. Thank you so much for listening, and I hope that this offers some both education and enjoyment, and we'll have more coming soon. All right, thanks, bye.